Hello, I'm Josh O'Connell, and this is episode 2 of Irish Tax Unwrapped. Whether you're a business owner, an investor, or just curious, we break down Ireland's tax code for everyone. Budget 2025 is being delivered in a climate of heightened anxiety. We have a cost of living crisis, a housing crisis, growing child poverty, a government breaking its own spending rules, a hollow tax base that relies on a few multinational companies for the bulk of corporation tax receipts, underinvestment in education and healthcare, and that is before you consider what is going on with infrastructure projects such as Metro North and the National Children's Hospital. Notably, while Budget 2025 presents various financial gifts to ease the burden on individuals and businesses, inflationary pressures could diminish their long-term appeal. Today, to discuss Budget 2025, I have with me our regular tax experts, Derek and Daphne from Coventure Tax Consulting.
Hi Josh, nice to be here.
Thank you, Josh. Thank you for having me.
Let's start with you, Derek. Budget 2025 was introduced amid concerns about inflation and rising costs of living. The Irish Fiscal Council has cautioned about the risks of injecting more money into an already heated economy. What do you make of this balancing act the government is attempting?
The government is walking a pre-election tightrope here. On one side, there's immense pressure to provide relief to households and businesses suffering from high inflation. On the other hand, too much spending or overly generous tax cuts could push inflation even higher. Is the economy strong or on fire? What will happen next year when the impact of these tax cuts, increased reliefs and public spending take effect? We'll have to wait and see.
Okay, but give me the tax perspective.
From a tax perspective, Budget 2025 offers the usual mix of positives and negatives. It's hard to get excited about minor changes to tax bands and USC. The impact felt by the SME sector will be minimal, I think. The extension of mortgage interest relief is welcome, but only a short-term fix. Inheritance tax thresholds have finally risen, which helps with estate planning. But these changes are long overdue and, frankly, underwhelming. The capital gains tax and inheritance tax rates remain at 33%, which everyone thinks is unfair. For businesses, there are some minor measures like the extended startup relief and green incentives for low-emission vehicles. However, established businesses and high net worth individuals just may feel underserved. It's hard not to feel that the government's focus is on multinationals and that social measures such as targeting bulk buying of property or incentivising landlords, a much maligned but important group, are just not thought through.
So thanks, Derek. That's the table set. Daphne, let's turn to the tax changes. We've seen some significant adjustments in tax bands, tax credits, and the Universal Social Charge, USC. Could you break down the major changes for us, especially in terms of what everyday people can expect?
There are the usual changes to the tax bands and USC, which are aimed at easing the burden for middle-income earners. The tax bands have been adjusted upwards, which means people will be able to earn more before they hit those higher tax rates. Business owners will see a small benefit from these. More significantly is likely to be the extension of the temporary mortgage interest relief introduced last year, Budget 24, and this is now extended for one more year. So basically, homeowners with outstanding mortgage balances between $50,000 and $500,000 at December 22 can claim relief on the increased interest they paid in 2024. However, this relief is capped at $1,250 per property.
That sounds helpful, especially for homeowners who have been hit hard by rising interest rates. But will this relief be enough, or is it more of a temporary fix?
It's definitely a short-term fix. The relief provides immediate help, but it's capped, and it won't fully offset the rising cost of mortgages.
And what about the changes to gift and inheritance tax thresholds? That seems to be a hot topic, particularly for families looking at estate planning.
The gift and inheritance tax thresholds have seen a notable increase. For instance, the tax-free threshold for gifts from parents to children was raised to $400,000. It had been sitting at $335,000 since 2019.
Could it have been better?
It could have been a lot better, but it certainly will help with tax planning. Blood relatives can now gift up to $40,000 tax-free, and non-relatives can gift $20,000. and they will also help a little.
What about the rates of tax?
While thresholds have increased, the actual tax rates, 33% for both capital gains tax and gift inheritance tax, have remained the same. This means that larger estates will still face hefty tax bills.
Unless they take expert tax advice, of course. Derek, let's shift gears to the corporate side. What do you make of the tax measures aimed at businesses, particularly small startups and farming enterprises?
Not a lot has changed in this budget for businesses. For small companies, the corporation tax startup relief has been extended. This is a relief available to companies with a tax liability of less than 40,000, or in some cases up to 60,000, and it's claimed in the first 5 years. The relief was pegged to the company's employer PRSI contributions, but then no credit was given for the Class S PRSI paid by the founder's shareholder. This has changed, but as with most SME tax reliefs, the change is quite small.
And VRT?
The emissions-based VRT changes are helpful. So commercial vehicles with low CO2 emissions will now qualify for a lower VRT rate of 8%. Apart from these measures, there's not a lot else to talk about.
OK, so what about the farming sector? There's been a lot of talk about farmers' exposure to residential zoned land tax. What announcements have been made in this space?
Well, there was a lot of focus in the lead up to the budget on farmers and their exposure to residential zoned land tax, or RESULT. This was well covered in the media, and there was no surprise that the budget contains a carve-out allowing active farmers to avoid liability under this tax. Significantly, farmers will be given a second bite of the cherry to have their land rezoned to avoid exposure in the future.
That's interesting. Anything else?
Farming has been a focus of this budget in other ways. There's a continuation and extension of stock reliefs, which are deductions from trading income to help farmers manage their profits more effectively. General stock relief for young trained farmers, and relief for registered farm partnerships have all been extended until 2027.
Farmers have to invest significantly in plant and equipment. Is there any news on the capital allowances front?
Capital allowances regime for safety equipment and adaptive technology for farmers have been expanded.
Well, that's a good move.
Of course, this is a good move. It helps farmers invest in modernising their operations, helps them be safe while they're doing so, and hopefully be more productive and profitable.
We discussed inheritance tax and the rates of capital taxes. Derek, back to you. Can you give me a rundown of changes in the capital tax space that would help entrepreneurs?
Firstly, I'd mention the angel investor relief. This relief reduces the rate of CGT from 33% to 16% for individual angel investors. When it was introduced last year, it carried a lifetime limit of 3 million. Thankfully, this has increased to 10 million. Secondly, following the narrowing of the scope of retirement relief in 2023, the forthcoming finance bill will extend the clawback period from 6 to 12 years for disposals intrafamily in excess of 10 million.
Can you put some more detail on that, please?
Of course. So prior to last year's budget, there was no upper limit on the value of business assets that could transfer to a child until the parent reached 66. It used to be that once a person reached this age, only the first 3 million would be exempt and CGT would be payable on the balance above the 3 million. Last year, the Minister announced that the age limit at which the 3 million limit applies would be increased to 70. However, he also announced that for those under 70, a lifetime limit of 10 million will apply. In this year's budget, a further change was introduced requiring the child to retain the business for 12 years or face a clawback of CGT.
I understand. So more limitations imposed on retirement relief, which business owners need to watch out for. You said you had 3 updates. What's the third?
The third and final point worth mentioning is that the relief for investment in corporate trades is extended until the end of 2025. This relief encompasses the Employment Investment Incentive, EII, Startup Relief for Entrepreneurs, SURE, and the Startup Capital Incentive, SUCI.
I think this comes up every year, no?
This is a running joke, as the first iteration of this relief was introduced in or around 1985, But anyway, the limit on the amount that an investor can claim relief on for EII investments will be increased from $500,000 to $1 million, and the relief for sure investments will increase to $140,000 per year, or a total of $980,000 over 7 years.
Let's talk VAT for a moment. The 9% VAT rate for gas and electricity has been extended until April 2025 to help with rising energy costs, which is great news for business and households. Daphne, are there other VAT changes in this budget that listeners should be aware of?
Yes, to give individuals and businesses a shot in the arm, the government has extended the 9% VAT rate on gas and electricity to mitigate the impact of rising energy prices. While it's a temporary measure, it will offer relief through the crucial winter months.
I note the government increased the VAT rate threshold slightly as well. What else struck you as interesting, Daphne?
Another notable VAT measure is the reduced rate on heat pumps, which will be lowered to 9% from January. This is clearly part of the government's effort to encourage homeowners to adopt more energy efficient heating systems, and this VAT reduction could help push more people towards making the switch.
Derek, there's been a lot of talk about the new stamp duty on high-value properties and bulk purchases of homes. What do these changes mean for your clients?
The new stamp duty rate of 6% on residential properties valued over $1.5 million is clearly aimed at luxury real estate. It's a progressive tax move that targets wealthier property owners, but it's unlikely to have a significant impact on the housing market, I think. It'll only apply to high-end homes, and it strikes me as a little bit of a land grab to finance some of the pre-election budget giveaways. More impactful, perhaps, is the increase in the stamp duty for bulk purchases of houses, which has been raised from 10% to 15%. By way of background, the Tax Strategy Group were asked to look at this and they gave a number of proposals. This is the one they've gone for.
I know you've done some tax planning in this space. While the focus of today's podcast is the budget, we might do a segment in the near future on the tax planning options around this measure. For now, I'd like to move on to sector-specific reliefs. Derek, we've touched on farming, but what about the film and media industry? There are some exciting tax credits and reliefs for this sector. Can you explain what's on offer?
The government is really focusing on boosting the Irish film industry with this budget. One of the most significant changes is the introduction of the scale uplift, which raises the tax credit for feature films to 40%. This applies to productions with a maximum qualifying expenditure of $20 million. It's a targeted measure aimed at small to medium-sized productions, which often face difficulties in securing funding. The idea is to help Irish and European cultural productions by creating more opportunities for investment in this sector. This, combined with the tax credit for unscripted productions, which was flagged last year, is expected to increase industry spending from about $90 million per year to $300 million per year. That's a massive boost for the media landscape in Ireland, and it will create jobs while fostering cultural growth.
Before we wrap up, let's touch on international taxation. Daphne, there's been a major shift toward a participation exemption for foreign dividends. Can you break that down for our listeners?
Sure. From next year, Ireland will move to a participation exemption for foreign dividends. This will be a big change in how foreign profits are taxed here. Currently, we operate a system of double taxation relief, where companies get credit for taxes paid abroad. The current arrangement is complex and hard to manage. The participation exemption model means that foreign dividends won't be taxed in Ireland at all, simplifying the process for multinational companies.
It's an important change. The Coffee Review in 2017 recommended this shift towards a territorial tax base, and we've been moving in that direction ever since. So the participation exemption will simplify things for companies, for accountants, for tax experts, and it's just another good step for Ireland to take to shore up its position as one of the hubs for international business.
Thank you both for this comprehensive breakdown of Budget 2025. Before we close, What are your final thoughts? Derek, do you think this budget will effectively tackle the challenges it aims to address?
The budget offers a lot of targeted reliefs, but the real test will be whether it can curb inflation while still providing enough support to households and businesses. If inflation isn't kept in check, much of the relief could be eroded by higher prices. That said, the focus on sustainability and supporting key sectors like farming and film is promising.
And Daphne, from a tax perspective, do you think this budget hits the right notes?
There's definitely a lot in here for both individuals and businesses, especially with the tax breaks for homeowners, startups and farmers. The changes to gift and inheritance tax thresholds are significant, but the government will need to watch inflation closely to ensure that those benefits don't get swallowed by rising costs. Overall, it's a well-rounded budget, but it will need careful management to deliver the intended benefits.
Well, we'll certainly be keeping a close eye on how things unfold. Thank you, Derek and Daphne, for your insights today.
Thank you for having me.
Thank you.
That completes this episode of Irish Tax Unwrapped. We hope you found the information helpful. Don't forget to subscribe, rate and share the podcast if you enjoyed today's discussion. If you have any questions or topics you'd like us to cover, feel free to reach out. Until next time, keep your finances in check and your tax knowledge sharp.